Welcome to Chapter 3, Financial Statements Analysis and Financial Models. In Chapter 3, we'll discuss how to use the financial information shown on the financial statement. Let's look at 5 issues in this chapter. The first one is financial statement analysis. We will introduce common size balance sheet and common size income statement. The second is ratio analysis. There are many financial ratios, but they were all different and we will use them differently. And the third part is the DuPont identity. The DuPont identity examines the interrelationship between the financial issues, especially in the return of equity. And we will examine how other factors affect the return of equity. And the fourth part is financial models. In this part, we will look at the financial models on our textbook and we'll examine the models together. The last part is external financing and growth. We'll examine the relationship between external financing and the growth of the company. Okay, let's start from the first part, financial statement analysis. When we make decision on investment or financing, we need to compare 2 or more companies usually by using their financial statement. But sometimes it's very hard to compare the numbers on the financial statement because the companies have different size, they have different concentration. So the common size statement can solve this problem because the information shown on the common size statement were shown as percentage rather than the total dollars. I will introduce 2 types of common size statement. One is common size balance sheet. On a common size balance sheet, all the numbers were shown as percentage of the asset. And on a common size income statement, all the numbers were shown as a percentage of the sales. So it is very easy to compare 2 companies as percentage rather than the dollars, the value of the dollars. And another good thing is we can compare, we can easily see the growth and the change of the company during the last couple of years. It's very visual information to us. The table on our textbook, table 3.1, 3.2, 3.4, and 3.5 are examples of the common size balance sheet and common size income statement. Okay, next let's look at the second topic, ratio analysis. There are many financial ratios as we talked at the beginning, and we can group them into 5 categories. The table on page 19 gives us a general picture about these 5 groups and these financial ratios in each group. The first group is short-term solvency or liquidity ratios. This group focuses on to evaluate the company's capability to meet its current liability. The ratios include current ratio, quick ratio, and cash ratio. The second group is long-term solvency or financial leverage ratio. This group focuses on the company's capability to meet its long-term liability. The ratios include total debt ratio, debt equity ratio, equity multiplier, times interest earned ratio, and cash coverage ratio. The third group is asset utilization or turnover ratio. This group addresses the company's ability to use their assets, their efficient use of assets. And the ratios in this group include inventory turnover, days sales in inventory, receivables turnover, days sales in receivables, total asset turnover, and capital intensity. And the fourth group is profitability ratios. This is a very important group to evaluate the company's profitability, how profitable the company is. And we have profit margin equals to net income divided by sales, we have return on assets, or ROA. It got by net income divided by total assets. We have return on equity, or ROE, equals to net income divided by total equity. And the last group is market value ratio. The market value ratio focuses on the price of the stock. And we have price earning ratios, market to book ratio, and the EV multiple. So these are all ratios. So many ratios have different use. And next, let's look at the third topic, the DuPont identity. The DuPont identity is kind of how to use these ratios, how to combine them together. And DuPont identity especially examine the return of equity. We all know that return of equity equals to net income divided by total equity. Because it is the equation, we can times 1 on the side of the equation. And this is sales divided by sales, and this one is assets divided by assets. Then we restructure, we regroup these 6 items. We use net income divided by sales, which is profit margin, and sales divided by assets, which is total assets turnover, and assets divided by total equity, which is equity multiplier. So it's easily to see that the return of equity is not only net income divided by total equity. Actually, it's composed of 3 factors. If these 3 factors increase, then the return of equity will increase. So from the DuPont identity, we can tell that ROE is affected by 3 things. The first is the operating efficiency of the company, which is the profit margin, and the second is asset use efficiency, which is the total assets turnover, and the last one is financial leverage, which is equity multiplier. So this is a good example to show us how to use these ratios to analyze the specific ratio of equity. There are still some problem with these financial ratios because there is no specific standards, specific quantity we are looking at. There's no bottom line, there's no benchmarkers. So we can only compare with these factors, like which is bigger, which is higher, which is lower, but there's no absolute standard, like which is the bottom line. So this is a problem with the financial ratios. Next, let's look at the financial models. Let's look at page 95. On page 95, the first model is a simple financial planning model. This model is simple because all the items were showed as the same rate of growth as the rate of sales. For example, if the sales grows 20% next year, and the cost, net income, debt, equity, all these items will grow at the same rate, are supposed to grow at the same rate, 20%. So it is very simple, but it's not that accurate because now the items on income statement and on balance sheet are actually related to sales. For example, on long-term debts, for example, stockholders' equity. So the next approach,